Good evening, everyone, and welcome to the UTI Fixed Income Market Insight for the month of August 23. We will be discussing our views on how the market trends are panning out, our thoughts on the RBI policy yesterday, and what kind of strategies make sense in this kind of scenarios. So we'll start with the global trends. We'll come to the domestic, uh, major drivers for the market, and then we'll come to the RBI policy. So if we look at the global trends, so the economic activity, as the world is now normalizing post the pandemic as well as the geopolitical tensions of last year. The manufacturing sector is still slowing down, as we can see by this JP Morgan Global Manufacturing PMI chart on your left-hand side. And it's now kind of stabilized, but it's still below the 50 level, which kind of signifies stability, and above 50 signifies expansion. So it's still not expanding, it's still below 50. One of the reasons that we saw that pickup in manufacturing is actually, if you see the chart on the right hand side, which is the household saving rate, and that's a percentage deviation from the 2019 end quarter. So basically it's kind of rebases the saving as at the end of 2019, and basically it's expressed as a percentage of the household saving data as at the end of 2019, which is just before the pandemic hit us. And if we see this chart, we saw these household savings taking a sharp spike during the period of 2020 and 21, as we know that as everyone worked from home, as nobody had too much avenues to spend on travel, other discretionary items, there was a big pickup in spending on consumer durables and other manufactured products, which also coincides with the sharp pickup in the global manufacturing that we can see on the left-hand side of the chart. But as that saving rate is now coming down, if you see, especially for the US, that saving rate has come down quite significantly, and even for the other economies compared to 2020 and 21 levels, we expect the manufacturing growth to continue to remain muted for some time, and that will have some bearing on how we look at global growth as well. So while the service sector is continuing to be stable, it's a slowdown in the manufacturing which is pulling down the global GDP growth, and at some point of time will also could lead to a more weaker labor market and a weaker core inflation as well. If we look at this commodity and food index, and the left hand side of the chart represents the Bloomberg Commodity Index, and that, as we can see, it's come sharply from the highs that it made just post the Russia-Ukraine war. And if we see the current levels as at the end of July, it's although it's lower than what we saw last year, but it's come up in the last 2 months, largely due to pickup in oil prices on production cuts by some OPEC members, as well as pickup in some commodity prices like copper, gold, etc., which has led this index to this appreciation. But broadly, if we look at from a year-on-year basis or broad trend basis, the trend is not alarming. Even on a year-on-year basis, the commodity index is quite stable. Coming to the food index on the right-hand side of the chart, even the food index, although it has come up from the bottoms that it made in April to May 23, is still in the negative territory. So although because of erratic weather patterns, especially locally, we are seeing pickup in food prices, especially cereals and some vegetables, but broadly at an aggregate level, food inflation, especially on a YOY basis, is still declining, and that also bodes well for world inflation. As we can see In these charts, these are basically how inflation rates in key global economies are panning out. And if we see most of the inflation across major global economies are continuing to see a declining trend. On the right hand side of the chart, we can see the peak headline CPI and their the previous month's numbers. For most of the economies, the current inflation is much lower than what they saw in the peak and close to the target levels. The next critical part uh, of this evolution of these inflation and hence central bank reaction function will be the speed at which these inflationary trends get close to the target level. So as we know, for most of these economies, the inflation target is close to 2%. So the journey from 9%, for example, for the US to 3% currently was not easy, but nevertheless, it was possible after all these rate hikes. What the bond market participants will be interested in will be that how fast the journey from 3 to 2% can be made in the upcoming months before the central banks, especially the Federal Reserve, is able to pivot from its restrictive policy to a more neutral policy. And this chart signifies uh, the market participants' perception of interest rates, basically through swaps. If we look at these charts compared to 30th June 23, 31st July 23, largely despite the spike in commodity prices, despite the spike in food prices, largely the expectations are still of rate cuts. As we can see from the left-hand side of the chart, the market was pricing in about 4 rate cuts till end of 2024. Even in July 23, the market participants are still pricing in, four and slightly more than 4 rate cuts in 2024. So broadly, despite uh, the temporary spike that we see in food prices globally, the bond market participants are still expecting overall inflation to trend down, economic activity to slow down from current levels, and hence uh, the market participants are expecting rate cuts to follow through in 2024. This table reflects the 10-year sovereign yield movement in key economies. As we can see, although the rate cut expectations are still very much there, in the last 1 month, for most of the major economies, bond yields actually went up. The reason was also slightly technical because, as we know, the that there was a government standoff in the US because of debt ceiling till June, and there was very limited issuance of long dated securities. So as the debt ceiling got resolved in June, and as the US Treasury started to issue more long dated securities because of overall supply pressures as well, and overall stronger than expected economic data in some specific economies, we saw this kind of yield movement. And since for most of the key economies, the anchor bond market is still the US market. Because of this pickup in yields in the US, we saw these kind of movements that we saw during the month of July. Coming to India trends. So if we look at the GDP growth projection for India, RBI has retained the forecast of 6.5% for FY24 and was also projected 6.6 for Q1 of FY25. The reason being recovery in Kharif sowing and rural income. And also RBI expects consumer optimism to continue, and that should ultimately reflect in strong services spending. As we know, more than 60% of our GDP comes from consumption. So broadly, that consumer optimism, recovery in rural income, as well as a strong service economy is quite critical for us. And as RBI expects overall optimism to continue, possibly all throughout Q1 FY25. Probably that's the reason for this kind of estimate. Uh, we may be slightly lower than this because our overall assessment is that given the slowdown in global economic activity, that may also kind of transmit towards softness in our exports as well, and that may lead to some reduction in service related activity as well, on consumer spending as well, and probably growth could be slightly lower than what what RBI is forecasting for now. In terms of inflation, this the left-hand side chart represents RBI's current assessment of inflation forecast for Q2 FY24, which is 6.2, and Q3 FY24, which is 5.7. And this is quite important because in next 2-3 months, we are likely to see inflation prints above 6% because of the temporary spike in vegetable prices because of erratic weather patterns. Typically, these are seasonal. They tend to occur once in a while during these months between June to August, and then they tend to reverse in couple of months. The important thing is, since RBI has already projected a slightly high number for the quarter two and quarter three for this fiscal year, the expectation from the market, in case the numbers are high from RBI, tend to reduce because the current RBI's rate actions are already taking into account these kind of projections. So if the projections were lower and if RBI was slightly more, uh, you know, sanguine about inflation, probably any upside surprise would have led to any aggressive rate action in the upcoming policy. But since RBI has already incorporated these inflation projections in its estimate, probably that uh, expectation of any adverse reaction kind of slows down. This is the chart of liquidity. As we can see, the banking system liquidity has been quite abundant since the period of beginning of June 23. The reason being very strong FPI flows in our equity market, and also the 2,000 rupees withdrawal exercise, where uh, more than 80% of the outstanding stock of 2,000 rupees note has been deposited back to the banking system, which has resulted in this kind of abundant liquidity. RBI did try to absorb this liquidity through introduction of periodic variable rate reverse repo, but since they were not being taken up quite aggressively by the banking system, yesterday in its policy, RBI introduced ICRR, or incremental cash reserve ratios, where banks will largely have to uh, deposit about 10% of their net deposited time liabilities accrued between 19th May till 28th July with RBI, which translates to about 1 lakh crores as per RBI's assessment. So while we believe that this is one of the least disruptive ways where RBI could have intervened to kind of impound this liquidity, so instead of giving a more direct measure like a CRR hike or doing any MSS sale or any OMO sale, which would have been much more disruptive to the bond market, this was one of the better ways to absorb this liquidity and should lead to minimal market disruption, because anyways the banking system was providing was parking money with RBI through SDF window and through other periodic reverse repo auctions. So instead of money going in those instruments, probably banks will have to park money with RBI in the ICRR. The only difference is that yes, in those SDF or whether in variable rate reverse repo auctions, money also gets. Banks get remunerated for the same. In the ICRR, banks will not be getting remunerated for that. So that's largely the difference between these two windows. in terms of how the monsoon has been progressing. So, as you know, we have been talking about some of the spike in food inflation has also come of very erratic weather patterns. If we recall at the beginning of this southwest monsoon, it was apprehension. There was a apprehension in the mind of various economists and policymakers that the monsoon could be quite weak, and overall crop sowing could be quite low compared to last year, and it could lead to significant food inflation. So, if we look at the spatial distribution of monsoon rainfall at an all India basis, monsoon is actually 6% higher than normal as at the end of July. If we look at northwest, central, south, all these parts have received excess rainfall than normal. It's only, unfortunately, the east and the northeast part which is still under deficit, and that deficit is also coming down and should improve in the next 1 month. If we look at an all India aggregate level of area sown under Kharif crops, uh, rise, which is quite critical for India's food inflation, in fact, has seen better sowing than last year. Uh, Oil seeds, sugarcane also have seen better sowing than last year. Cotton is largely flat. It's largely the pulses which are seeing meaningfully lower sowing compared to last year. But given that government is actively trying to import many of these pulses varieties from rest of the world, probably the impact on the ground inflation will not be as meaningful as some of the market participants may would have feared at the beginning of the monsoon. So overall, the effect of this erratic weather pattern, the effect of El Nino, uh, as of now seems to be more transitory. It will remain to be seen that how monsoon emerges for the next months, how uh, global food prices behave, which are still behaving for most of the food articles in a more range-bound manner. So we do expect once these vegetable prices to go down, overall inflation should also come down in a gradual manner, and we may not need any more. We do not expect any more RBI rate action. Uh, you know, because of these temporary food inflationary pressures. Coming to how the fiscal trend is panning out, if we look at comparing it to FY23 as well as comparing it to the budget estimates, so the income tax collection is quite healthy. It is almost comparable to the budget estimates of FY24. Despite the very high base of FY23, whether we look at customs and GST as well, the tax collections are quite healthy. The only slight kind of a worry would be the corporation tax, which is slightly on the weaker side right now. But corporation tax sometimes tends to pick up in the second half of the financial year, because typically economic activity tends to pick up in the second half. So we will still need to see. I think it's too premature to say that the corporation tax this trend could continue. So we will need to see going forth as well on how this pans out. If we look at whether dividend, because of very high RBI dividend, which was about 50,000 crores more than the budgeted estimate in terms of dividend profits, that looks to be much higher than what the market participants were estimating at the beginning of the financial year. The disinvestment program is yet to start. Typically, that also is back-ended, and hence we will need to see close to the end of the fiscal year that regarding the progress of disinvestment. And if we come to the expenditure side, what's most heartening is if you look at the capital expenditure, which has grown by 59% compared to FY23, and much above the run rate required in the budget FY24, largely because the sector has been releasing payments to states for their capital expenditures on time. In fact, one tranche was delivered prematurely so that the states have sufficient time to undertake their capex. So overall, on capex side, government has been quite aggressive in releasing the payments and carrying out their schemes to get the best or the most optimal growth multiplier they can get through this channel. If you look at the trade deficit for June 23, it came at around 20.1 billion. Uh, I mean, it's improvement from May, but it's still a 20 billion number. It's still slightly on the higher side. If we look at where largely the areas of improvement, was uh, on the oil imports, where if we see the oil imports fell from 15.6 to 12.5 billion, although the non-oil, non-gold imports also fell. Uh, uh, I mean, it was also, if you look at the export section, which is the non-oil exports, that also fell reasonably from 29.1 billion in May 23 to 27.4. So that also, so I would say both in terms of economic activity. So like we said in the beginning, that because of the overall household savings now stabilizing close to 2019 levels, the overall economic activity is also slowing down. So that's reflecting in our non-oil, non-gold imports as well as our exports uh, largely. But although the trade numbers look slightly weaker in terms of BOP, because of very strong FPI flows that we have been experiencing, our overall BOP number should still be quite manageable. In fact, we should end this year with a slight BOP surplus. So from that perspective, our trade numbers are not a cause of worry for now. This is largely the shape of the yield curve as of July 23, June 23, and last year. So as we can see, the curve continues to be largely flat with minimal spread between your 3-year to 10-year, even to long end of the yield curve, largely reflecting the change or from market participants from a rate action standpoint from the central bank, since overall market participants expect RBI to be on a long pause. uh, the short end continues to be very close, and the spread between the short to long end continues to be quite compressed. It's usually typically during the rate cutting cycle when the short end starts getting anchored to the headline interest policy rate, and that's when the curve starts to steepen much more sharply. So, like I was explaining, the yields hardened for 3 years and above duration bonds last month, as we saw in the bond yields for the key economies in one of the previous slides. Typically, across the bond markets globally, yields hardened by 10-15 basis points, largely coming in from the movement of US Treasury. Because if we look at largely two factors which is driving interest rates, it's either uh, local inflation or it's global cues for the bond market. If you look at wherever inflation is close to their target levels, those central banks, such as especially central banks in Latin America, they have been able to cut interest rates because they were much ahead of the Federal Reserve and other advanced economy central banks to start hiking as well in this monetary cycle. Wherever inflation is not close to the central bank's target, there the bond market is largely anchored to the global interest rates, most notably the US bond market, because that's where they're getting cues that probably their central banks will be able to normalize interest rates as and when the Federal Reserve also starts to normalize. So that's where we are seeing this kind of coupling happening between the US interest rates and some of the other bond markets. India is also, especially in the last 1 to 2 months, is more closely following the US bond market than it has seen historically. So largely, what does it mean, or what's the takeaway for the investor? So as I discussed about the policy, that one, RBI has kept the repo rate unchanged. It has kept its stance unchanged. It has uh, revised its inflation projection to take into account the spike in food prices without sounding very hawkish. So when the bond market was approaching yesterday's RBI policy, there was a widespread concern that RBI could sound very hawkish and could sound very concerned uh, on some of the near-term inflation prints, which could have kept much more room for future rate hikes going forward. Uh, so, given that RBI largely acknowledged that these price hikes are more of temporary because of some weather disruptions, and they are likely to look through them. That gave a relief to the bond market. And if you look at the liquidity, like I said, this ICRR, since this will be reviewed on 8th September, this also seems like a temporary measure. And like RBI said, it was largely introduced because the banks were not using the long tenor VRRs, and hence RBI had to introduce this measure. So it's not really, doesn't seem that it will stay on a more durable basis. And hence, from both liquidity stance or rate perspective, the policy was quite a non-event. If we look at how the bond market could move going forward, largely the driver for bond market, unless and until our inflation is close to our target, would be how global central banks are reacting. And global central banks typically would tend to react either when they see a durable correction in inflation close to their target, or unless and until they see a major headwind to growth, where they have to, for a time being, not focused too much on inflation, but focused on macro stability and growth, like they did during COVID, or they did during the 2008 financial crisis. And that's something which is not really there right now. So if we see, yes, we are seeing decline in economic activity, but it's not so sharp for central banks to abandon their inflation targets. And hence, like we are saying, barring an economic shock, the policy easing cycle uh, is likely to be shallower in India compared to advanced economies, because policy rates in India are close to more neutral levels than for rest of the world. If we look at the average interest rates in the US or the Eurozone or the UK for the last 15 years and compare their current rates to those levels, they are much more restrictive. Whereas if you look at India, and you look at last 10, 15 years, the current interest rates are not that high compared to what we have seen historically. And hence, when the policy normalization cycle also starts, the rate cuts that could happen globally would be much higher when compared to what would have happened with India. So given the current macro backdrop, that yes, there could be a easing cycle, but the easing cycle could be slightly shallower. One Second, we are basically moving in from a period of high growth to a low growth. We are moving in from a period of high inflation to a more moderate inflation. And if you look at the yield curve, like we discussed, right, it's largely reprice, it's largely flat. We are not getting any meaningful, uh, you know, term premium to buy long duration. We believe that portfolios with moderate duration are much more appropriate from a risk reward perspective, as they provide very reasonable accrual with an also opportunity to participate in the easing cycle whenever it commences in the next 6 to 12 months. If we look at from a investor standpoint, typically investor uh, should also look at their time horizon apart from their risk reward. So, if an investor is investing from a 6 to 12 months perspective, uh, given that we don't really expect rate hikes in India for now, investors can consider allocation to low duration or money market strategies compared to, let's say, a liquid fund, because in next 6 to 12 months, we believe these strategies can outperform, uh, let's say, very short duration strategy. And investors who have a more long-term horizon, which is more than 12 months, can consider allocation towards moderate duration categories, which is your 1 to 4 year category, which could be your high quality short term corporate bond or a banking PSU kind of a product, where they can earn very reasonable accrual with also an opportunity to participate whenever the interest rate cycle starts to turn. So thank you. Thanks a lot for listening in. That was largely from my side. And of course, mutual funds are subject to market risk. So please read all the scheme related documents carefully before investing. Thank you, and happy to take up questions.
Thank you, Anurag, for sharing your insights on the market and covering the policy that of RBI policy happened yesterday. Uh, so, taking up the questions, I would request participants to keep posting the questions on the link provided to you. In the meanwhile, I'll take up the questions which are already there with us. First question is, although inflation expectations are moderating, rising oil prices is there and vegetable prices are also high. So considering all of these challenges, and RBI in its current policy also increased the CPI forecast. So what do you think the RBI can increase its policy rate if the inflation inches further, or it's gonna pause for a long?
So we think RBI is on a long pause because till they see inflation durably moving towards 4%, or unless and until they see a major economic shock, they are likely to be on a hold. But if regarding your first question, that whether we are likely to see, any major rate hikes if inflation continues to be on this trend. So if we look at where their projection is 1 year ahead, so despite the current food price shock, uh, they are expecting an inflation of 5.2% in the Q1 of FY25. So even if you look at with their current repo rate of 6.5, it kind of makes for a real rate of 130 basis points. So, and typically we've seen historically, RBI has been comfortable with a real rate of about 100 basis points. So even with all these shocks, of course, the assumption is that these food price shocks will dissipate in the next 3 to 4 months, as in when the next season arrival starts to come in terms of vegetable, fruits, and the other crops as well. So, of course, if uh, the weather will continue to remain disrupted and these food prices will continue to remain high, of course, RBI could sound more hawkish. And RBI also clarified that they may not have to act just through interest rates. They just like they acted through ICRR to absorb the temporary liquidity, they have other tools as well to kind of anchor market interest rates. So it's very difficult to say right now that RBI may have to hike just for a couple or 2-3 months of reading of slightly high inflation.
Sure. So next question is also related to the policy. So RBI has been taking different measures to control system liquidity. And yesterday it introduced this new tool, implemental CRR, which you also covered. So can you also throw some more light about this move of RBI? And also, so do you see it can have some significant impact on the yields at the short end of the curve or short to medium end of the curve? Your views on
Right. So in the very near term, this move may cause some impact on the short end of the yield curve. Largely, the reason behind this, introduction of this ICRR is because one, we have seen high RBI intervention on the FX market. because of the strong FPI flows we have gotten on the equity side. And secondly, because of this 2000 rupees, cleanup exercise or the exchange exercise that the government of India has undertaken. If we recall, when this exercise was announced, there was an expectation and comparison by market participants with demonetization, that during demonetization only 30% of the currency stayed in the banking system, and ultimately everything went back. So initially there was expectation that only 30% will stay in the banking system. But if you look at the current trends, I'm not saying that all this money will stay, but if you look at the current trends, about 80% of the whole outstanding currency is now, the 2000 rupees note is now still staying in the banking system. There is a uh, reasonable possibility that this liquidity will go away through natural currency accretion in the next 12 months. But at least for now, this money is now with the banking system. So the whole idea behind RBI is not to disrupt the market. The whole idea behind this RBI move is not to durably suck out the liquidity. It's only to optimize the liquidity with the banking system. Because of this, these two measures, which is FPI flows, and like we all know, FPI flows are not permanent; they are fickle. So to manage this temporary liquidity because of FPI flows, as well as this 2000 rupees note, and also if you look at how RBI introduced this, the way RBI governor introduced this facility was that they have been trying to introduce long-term VRRRs in the market so that banks park that liquidity with RBI for a long period of time. But since the banking system was unable to do so, they are bringing out this measure only till 8 September. In fact, they have even kept the flexibility to remove this measure before 8 September as well, so that banks have enough liquidity to lend before the festival season starts. Also, we have advanced tax outflow in the mid of September. So probably before that, anyways, there will be a review whether this liquidity is needed or all. So at least judging by the actions of RBI, it does not seem to be disruptive. Yes, in a very near term, there could be some impact on very short term yields. But if you look at from an overall yield curve perspective, this does not really should not have a material impact. Thank you.
Sure. Moving on to the next question. Since yield trajectory is a lot more dependent on US Treasuries, and because of the strong non-farm payroll and employment data, USD is expected to remain elevated. Do you think this will create some volatility in the domestic rates also, since yields have remained broadly range bound with no major movements either ways?
Right. So we think that US or the global economy is in the late growth cycle. So when you are in a late growth cycle, the data can be wobbly on both sides. So you may have surprise in 1 month on the upside and on the downside as well. So yes, yields, especially on the long end, could be more volatile. And also, if you look at the current interest rates in most of the advanced economies, they are way above their uh, long-term trends in the last 20-25 years. So yes, bond markets can remain volatile for a while, especially on the global bond markets. And compared to the volatility in global bond markets, I would say the Indian bond markets are much more range bound and much more stable, because if you look at the nature of the inflation that India is facing, that's largely supply side, it's not demand led, and that's largely still expected to be transient. So yes, there could be volatility, and that's why we are recommending that investors who have a more than 12 months investment horizon should only invest in moderate duration products, and not less than, if you have less than 12 months, then probably these volatile products are not suitable for you. So there will be intermittent volatility. But as long as the investor is comfortable with the intermittent volatility and has a reasonably long-term investment horizon in mind and is able to ignore all the noise, in the next 12 months, probably, like I said, you will be in a much more moderate inflationary environment. You will be in a much more moderate growth environment, which is still quite constructive and positive from a fixed income standpoint. So as long as the investor can ignore the noise and daily volatility, see, on a daily basis, market has to go somewhere. So it will, on days it will go up, days it will go down. But as long as the investor can stay invested for a period of time, uh, it is a reasonably constructive period for fixed income.
Surely. So next questions is related to commodities. So what is driving oil prices? No, it touched 85 USD per barrel, and it was hovering around 75 a month ago. So what is really the driving force behind this increase in the crude prices?
Right. So crude, the oil market is a very complex market in itself. So we don't tend to be, or we don't profess to be experts on that. But largely, as a market watcher, I would say one of the reasons was, of course, production cuts announced by uh, many OPEC members, such as Saudi Arabia, Russia, etc. And since the suddenly, because the market participants were not expecting any cuts, so the announcement of the cuts also led to these idiosyncratic factors. But if we look at historically how the oil market has behaved, typically the oil market also works on fundamentals mostly. So in case there is a moderation in economic activity, typically there could be months where, because of these local factors, oil prices may not behave in the usual way. But typically, over a medium term to long term, oil prices tend to move in lockstep with overall economic conditions.
Sure. So next question is related to China deflation, which it was in news 2 days back. So since China is facing deflation now, so how does it impact global economies and in India in particular? And do you see it can lead to some inflationary pressures in India, some supply chain disruptions can lead to?
So largely the deflationary pressures which are coming out of China are two, I would say, two, three large reasons. One reason, of course, is uh, the real estate slowdown that China is facing for the last 2 years, since a lot of savings for Chinese households is locked away in Chinese real estate, which has not done well. We've seen cases of bankruptcy by many builders. We've seen cases of meaningful price erosion in many cases. Hence, there is that effect which is leading to overall consumption slowdown, and hence we are seeing this kind of deflation in some products. Secondly, what also happened was during the last 2 years, when there was a production supply chain issues, there to make up for that supply chain issues, many producers also, especially in semiconductors and electronics, many producers went into a production overdrive in last 1 year to ensure those that they don't face those supply chain issues again, and they built up a slightly excess inventory. So many of those factors, those excess inventory is kind of playing out, and it should course correct in the next 6 to 12 months. And of course, there are other factors like demographics, and also the Chinese consumers did not get that much of a government stimulus that many of the consumers, for example, in the US or the UK or the Eurozone got during the periods of COVID. So the savings delta that those consumers in the advanced economies got uh, is not the same what the Chinese consumers have, and that's why we're seeing the reasons of this deflation. So to summarize, one, the wealth effect, which is because of the real estate price issues. The second is excess inventory buildup, which is leading to this course correction, and the third uh, is the lack of stimulus, consumption stimulus, which has been given to consumers. So while some of these issues should settle down by themselves. Uh, but I would say, in fact, it's a welcome news for global economy because of these deflationary pressures. In fact, like we saw in the first chart, that the manufacturing PMI has been a downtrend for quite some time. So, in fact, the more China exports deflation to the rest of the world, the easier it will be for the other central banks to get their inflation in line with the targets. So overall, I think for the rest of the world, at least for now, it's a good thing to have, at least from a fixed income perspective.
Surely. So next question is also an interesting question. So sometime back we have been talking about India inclusion in the global bonds. Again, since the index review is now around the corner and the talks have restarted, what is
Right.
your view here?
Uh, so we are also going by public. I mean, is there in public domain? So largely, I think both government of India wants to be in the index. The index provider also wants the Indian government bonds to be in the index because one, like we also discussed in one of the previous questions, Indian bond market is actually quite stable and much less volatile than even many of the advanced economy bond markets. And it's very deep and very liquid compared to many other bond markets. The only contentious issue is the tax treatment and the withholding tax, which the index provider has raised. So it's largely the choice of the index provider whether to include Indian government bonds with these features. Just to put things in perspective, there are other economies as well who have withholding tax and they are part of the index. So it's not that it will be an exception. Uh, Having said that, largely it's the decision of the index provider to include government of India or not. But if they were to include, it can over a period of time result in an inflow of 20 to 25 billion dollars in Indian government bonds. So that could be quite constructive for government bonds across the curve. The next review could be out somewhere in September from the index provider. So probably we will get more clarity post the same. But mind you, investors who are looking at allocation to fixed income should not really allocate based on these temporary factors. Overall, the the important thing fixed income allocation is that one must have a central bank who's committed to inflation targeting. And that RBI has demonstrated for the last 5, 6 years that it is committed to inflation targeting. What it really means when we say that a central bank should commit to inflation targeting is that if you look at last 15, 20 years, we have seen the mid bond yields at 8%, 8.5%. We have seen fixed deposit rates at 9%. But during those times, even the inflation was at 10%, 11%. So the investor, in a nutshell, was actually earning less than even the rate of inflation. But when you have an inflation targeting central bank, typically you end up getting a positive real rate, which is typically on a gross basis, but can earn better than the rate of inflation. That is what is more constructive for fixed income investors. So yes, that can be positive for uh, you know, bond investors in the near term if India were to get included in the bond index. But uh, and that should happen over the period of next 2, 3 years. So investors who are anyways looking at fixed income asset allocation for next 2, 3 years should consider this. That probably as the global bond market deepens, they need a country of a magnitude and size like India to be part of the index. But it should not be the primary motivation.
Sure, sure. Since we are talking about India growth, inclusions, so next questions is related to the Indian GDP. Recently, in its July monthly bulletin, RBI said that India's real GDP needs to grow at some 7.6% annually over next 25 years to achieve per capita income level to become a developed economy by 2047, 48. It said to achieve this target, India needs to rebalance its economic structure by strengthening its industrial sector. And also, we are seeing that government is taking quite a good efforts in incentivizing
Right.
advising the manufacturing sector through schemes such as PLI. So, do you see any visible trends that GDP composition is changing in this backdrop? from being an agricultural economy to more of a
Uh,
manufacturing?
right. So I think these things take time to happen. And of course, government of India is taking a lot of steps to encourage manufacturing, especially on the new age sectors like renewable, like electronic vehicles, now semiconductors, pharma as well. So government of India is really trying to encourage through various measures, you know, and but these things, as for China or for Korea or for Singapore, these typically these uh, kind of measures take time, and you have to be in the right place at the right time. Of course, India is in the right place at the right time because uh, there are many global manufacturers who are looking for alternates, and moving to a more uh, kind of democratic uh, economies like India, which who also have a large domestic consumption base as well. But yes, it will take some time to pan uh, for that to happen. So we need to really see how these measures get accepted, uh, and what's the kind of impact. So it's too premature to give an assessment that how these measures will really lead to the outcome that we desire.
Surely. This question is related to floating rate bonds. So, how do you look at floating rate bonds considering these bonds have been performing really well in recent times? If you can throw some light on this?
Right. So typically, floating rate bonds, uh, price of a floating rate bond is a reflection of a market participants' view on interest rates or the life cycle of them. So let's say if a floating rate bond, just to give a very simple example, let's say if I'm have a floating rate 1 year CD, right, and let's say it's linked to uh, repo rate, just for simplicity. So basically, I have to compound my repo rate daily for next 365 days to get an annualized number for that 1 year CD. So if I have a view that okay, my repo rate will remain flat at 6.5 uh, for the next 365 days, it should probably compound to somewhere close to 680 in the next 12 months. If my view is that maybe the repo rate could get cut the next 3 months by let's say 100 basis points, my uh, the valuation of that CD, for example, changes, right? So in case there, at least we have a view that we have largely hit, peak in interest rates, and from here on, the next move is likely to be lower than higher. So in this kind of a scenario, and overall, even from a long-term perspective, uh, we do expect that given the government is focused on fiscal consolidation, as well as the RBI is very serious about inflation targeting, structurally, Indian rates should go down in the next 10-15 years. Thirdly, the bonds should be liquid enough uh, to for a fund manager to execute their view very smoothly. So at least for now, we think that floating rate bonds uh, are sometimes misunderstood because they are not very traded frequently. So they give a perception that uh, they are very stable, uh, and the yields that one sees on them is just a nominal representation of what market participants are thinking. As and when the rate cut cycle starts, the YTM which we see on these floating rate bonds could come drastically down, because that whole interest rate expectations get reset also very fast. So I would say if one has to have exposure to these floating rate bonds, it should be a very limited part of their portfolio and not a very large part of their portfolio, because typically one also depends on the duration of the floating rate bond. So if we are running a high maturity floating rate bond, the interest rate risk on that bond is the same of a plain vanilla bond. So probably one should have a very small allocation if in case one wants to have. But like I keep on saying, at UTI, we all of us follow one mantra to simplify things for investors. And one of the simple things for investors is that why are we there in fixed income, right? We are there in fixed income again to earn a reasonable return, to have stability of capital, etc., etc. Uh, when a simple product can do that job for us, it's better not to complicate it and try to optimize last some basis points to get into a product which can be quite volatile.
Clearly, essentially back to basics.
Yes.
Okay. So, considering we are closing near the closing time, we would take 2 or 3 questions. Uh, the next questions is related to the UTI Mutual Fund House's view on the duration for its fixed income funds. Is there any change that the fund house is doing, considering there's a long pause? So, increasing or decreasing the duration? Over to you.
So largely, of course, most of our funds are actively managed, and those views are subject to change. So my views on our actively managed funds are only, as we are today, and those in subsequent months they can change. Having said that, like I said, the we think that the global economic activity is now slowing down materially. And the thing about how the market functions or the reacts, if you remember last year, uh, when inflation started to go up, or even last to last year when inflation has started to go up, all the while many central banks were saying that inflation is transitory, but the bond yields had started to react much more in advance of rate hikes by many central banks. All right. In the same way, we think that bond yields, when they come down also, they will not wait for all the rate cuts to start, and they will try to capture the inflection points of growth and inflation decline. So we have slightly increased duration across our actively managed products to because, like I said, we are of the view that the global economic activity is slowing down, and at some point of time, the bond market will give more weightage to the need for growth than the need for just anchoring inflation expectations, and that is when probably duration could outperform. And when I say we have increased duration, it doesn't mean that we have increased duration very aggressively, given that we are yet to see how monsoon pans out, how food prices pan out, etc. We have marginally increased duration from in the last where we were in the last 2 months, and we will continue to assess as we go along on our views on how durable the fall in inflation is, how really whether the economic activity slowdown is a blip or it's a more long-term trend that we are seeing. So probably we are still not, I would say, at the highest point of our duration. So like we keep on saying, uh, right now what we like is the moderate duration product. So for example, a short-term fund which runs duration between 1 to 3 years, uh, or a corporate bond fund which is 100% AAA and runs duration typically between 1 to 5 years, and the banking PSU which is 100% AAA roll down. So these are the products that we are recommending to investors because uh, the moment there is a shift in market perception of interest rates, these funds can also give you some opportunity to participate in capital gains apart from also providing a reasonable accrual.
Surely. So, with this answer, actually, you covered a couple of more questions that were in the pipeline. So, I would just take the last question. So, Indian economy and growth outlook has been resilient all this while. So, what, according to you, could be the potential hurdles for Indian bond markets looking at the global economic slowdown?
Potential hurdle for bond market. for from an India perspective is,
Yes, yeah.
so I think if you look at the typically bond market works well in a more predictable policy environment and a more predictable macro environment. So if you look at the bond market for the US or for the Eurozone or for other advanced economies, they worked well because overall inflation was range bound for them. So largely, they knew that the central bank would come and intervene at certain point if inflation were to get too low below their target or get too high above their target. And they would intervene. And so that central banks had earned their credibility, at least till the COVID, that overall inflation will be well anchored. So I think we are also in a similar process. Uh, of course, our nature of inflation is different. 40% of our inflation comes from food, and hence it slightly tends to be more volatile than many other parts of the world. But that should also that composition should also course correct in due course of time. But broadly, I think uh, as you know, the government is committed to fiscal consolidation and fiscal improvement, as well as we have a central bank who's really committed to adhering to its inflation target and not just in a band. That should give comfort to our domestic as well as our international investors to take India much more seriously and look at India as an attractive fixed income destination as well.
Sure. With this, I would like to thank our participants and viewers to giving us this opportunity to present to you. And I would request you to keep sharing your feedback on the link provided to you. And thank you for asking questions. And Anurag, your closing comment, and that we can conclude this.
Thanks a lot, everyone, for joining in on the call. And we hope you enjoyed listening to our views. Please, like Sojal said, please feel free to share feedback on our call. Thank you. Have a good weekend. Thank you.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.